The last time I saw conditions line up like this, I called my closest advisors into a room. I closed the door behind them, and I told them to prepare for something the textbook said could not happen. That was 2007. Nobody listened. Not the desks, not the regulators, not the people who should have known better. 18 months later, the entire global financial system nearly stopped functioning. Lehman was gone. Bear was gone. Money market funds broke the buck. The plumbing of capitalism froze. And I sat there watching it unfold exactly the way I had described it in that closed room. I am calling that meeting again. And this time, I am opening the door. Because what Jamie Dimon said this week, what he hinted at in the language only people in the room understand, is the same thing I was saying in 2007. And the next 72 hours, the way this market digests what is coming, could change everything for anyone holding gold and silver right now. So I need you to sit down. I need you to put the phone away. And I need you to listen, because if you do not understand the mechanism I am about to walk you through, you are going to make the wrong decision at the worst possible moment of your investing life. Let me tell you where you are right now. You bought gold. You did everything right. You read the books. You watched the central banks. You saw the debt curve going vertical. You watched bombs fall in the Middle East. You watched Russia and Ukraine grind into year 3. You watched China stockpile. You did the homework. And you are sitting there right now watching your position bleed red, silver down more than 40% from where the smart money said it was going. Gold down double digits from its high. And every headline that should be sending these metals to the moon is instead being met with a tape that goes the other direction. Bombs are falling. Central banks are buying. Debt is exploding. And your screen is red. So let me ask you directly. Do you understand the actual mechanism behind what you are seeing? Because if you do not, you will sell at the bottom. You will sell to the people who do understand it. And 6 months from now, you will be the one saying the words I have heard 1,000 times in my career. I knew I should have held. I am not going to give you opinion today. I am going to give you a mechanical sequence. A sequence that has repeated after every single major oil shock and geopolitical event since 1973 without exception. By the end of this video, you will understand the exact mechanism. You will understand the historical record going back 5 decades. You will understand the 3 structural forces that are converging right now, and you will know the 2 specific indicators that will tell you the precise moment the suppression breaks. Once you see this, you cannot unsee it. And I will say that phrase several times today, because I mean it literally. Let me walk you through the sequence. The first thing that happens is a geopolitical event, a war, an embargo, an attack on infrastructure, something that disrupts the flow of oil. The second thing that happens is the oil price spikes. We have seen it again this cycle. Crude pushing on the upper bands every time a new headline crosses the wire. The third thing that happens is that oil spike feeds directly into inflation expectations. Traders, models, central bankers, everyone reprices the inflation curve higher. The fourth thing that happens is the most important. Those rising inflation expectations kill any hope of Federal Reserve rate cuts. The Fed cannot cut into rising inflation expectations. They will not. They have said it 100 times. The fifth thing that happens is bond yields stay elevated. The 10-year Treasury is sitting at 4.39% right now. It is not going to 3% next month, not while oil is bid. And the sixth thing that happens is the killer for gold. High yields raise the opportunity cost of holding an asset that pays you nothing. Gold pays no coupon. Gold pays no dividend. So when the alternative is 4.39% risk-free, capital rotates out of gold and into treasuries on a mechanical basis. And on top of that, at the exact same moment, safety buying floods into the dollar. The dollar index rips higher. And because gold is priced in dollars, a stronger dollar mechanically suppresses the gold price. So you have 3 headwinds hitting gold all at once. Higher yields, stronger dollar, rising opportunity cost, all 3 of them caused by the same event that should be bullish for gold. That is why your screen is red while the world burns. That is not a contradiction. That is not a market failure. That is mechanics. This is not opinion. This is mechanical, but here is where the story changes completely, because this mechanical suppression does not last. I have watched it resolve the same way every single time across 4 decades, and I am going to show you the receipts. Go back to 1973. OPEC announces the oil embargo. Oil quadruples. Gold initially gets hit exactly the way you are seeing right now. And then gold went on a run that ended at over 2,300% higher by January of 1980. Go to 1979. Iranian Revolution. The Shah falls. Oil spikes again. Gold goes flat for a moment. This is flat for a moment. The suppression mechanism kicks in just like the textbook says. And then gold rallies 89% in the following 12 months. Go to September of 2001. The towers fall. Oil spikes. Gold drifts. And then gold begins a decade long run from around $250 an ounce to over $1,800 an ounce. That is a 60% move, and it started from the exact same suppression conditions you are looking at on your screen tonight. Go to February of 2022, Russia invades Ukraine. Oil spikes. Gold pulls back. And then gold breaks $2,000 an ounce for the first time in its history. Every single time, every single time, every single time. Write this down. Every single oil shock since 1973 has produced an initial gold suppression followed by a structural breakout to new highs. There are no exceptions. Zero. It's not our job. And I want you to sit with that for a moment because what your screen is showing you right now is not the end of the gold trade. It is the setup that has preceded every major gold bull market of the last 50 years. Now I need you to understand something bigger. Gold is not just going up. Gold is being re-rated, and those are two completely different things. A price going up is temporary. A price going up can reverse. A price going up is a trade. A structural re-rating is permanent. A structural re-rating means the world's relationship with the asset has fundamentally changed. The role gold plays in the global financial system is being rewritten in real time, and most people watching their screens have no idea it is happening. I will come back to this idea of re-rating later because there is a specific moment, a specific morning that I want to describe to you. And when I describe it, you will understand exactly why I have been using the word unthinkable. Who is doing the re-rating? Look at who is buying. Central banks have been buying physical gold at a record pace for 18 consecutive months. China has been adding to reserves every single month for over 2 years. Russia has been accumulating for more than a decade. Poland, Hungary, India, Turkey, Singapore, the people who print money, the people whose entire institutional purpose is to defend fiat currency, are buying the one asset that fiat currency was supposed to replace. Think about what that means. The people who print the paper are buying the metal. That is not a portfolio adjustment. That is not a hedge. That is a signal. That is the loudest signal in global finance, and almost nobody in retail is listening to it. Let me be blunt with you. When the institutions that benefit most from confidence in paper currency start quietly accumulating the alternative to paper currency, something fundamental is breaking, and they know it before you do. Go back to August 15, 1971. Richard Nixon goes on television on a Sunday night and tells the American people he is closing the gold window. The dollar is no longer convertible into gold. The Bretton Woods system, the architecture of the post-war financial order, is dead. The dollar is untethered. And what happened to gold? Gold went from $35 an ounce to $850 an ounce in 9 years, a 24-fold increase. And I am telling you tonight, with 40 years of pattern recognition behind me, that what is happening today is structurally bigger than what happened in 1971. I will explain why in a moment. Because there are 3 forces converging right now, 3 forces that have never converged simultaneously in the history of modern finance. And I want to walk you through all 3. The first force is the weaponization of the dollar. In February of 2022, the United States and its allies froze approximately $300 billion of Russian central bank reserves overnight with a keystroke. Every finance ministry on the planet got the message at the same time. If it can happen to Russia, it can happen to anyone. It can happen to China. It can happen to Saudi Arabia. It can happen to any country that one day finds itself on the wrong side of Washington. And the response from Every non-aligned Treasury Department on earth has been the same. Diversification into the one reserve asset that cannot be frozen, cannot be seized, cannot be sanctioned remotely, and cannot be turned off by a keystroke in New York or Brussels. Physical gold sitting in your own vault. That is what they are buying. That is why the central bank bid is structural and not cyclical. That bid does not go away when oil prices fall. That bid is permanent because the loss of trust in the reserve system is permanent. The second force is the debt spiral. The United States is now carrying over $39 trillion in federal debt. Interest expense alone is running at approximately $1.3 trillion per year, more than the defense budget, more than Medicare, the fastest growing line item in the entire federal government, and we have approximately $9 trillion of debt that needs to be refinanced in the next 2 years. Refinanced not at the 0% rates of the last decade, but at 4 to 5%. Run that arithmetic. Run it yourself. A Fed cannot do what Paul Volcker did in 1980. Volcker took rates to 20% to break inflation. The arithmetic of our debt service does not permit a Volcker move today. Not even close. The only exit from a debt spiral of this magnitude is to inflate the real value of the debt away. And the moment the bond market truly believes that is the plan, the moment that belief becomes consensus, gold and silver will not rise. They will surge. They will gap. And by the time the consensus forms, the move is already over. The third force is silver, specifically. And silver deserves its own conversation because silver is the only asset on the planet that is simultaneously a monetary safe haven and a critical industrial input. Solar panels, electric vehicles, AI data centers, defense electronics, semiconductors, 5G infrastructure. Every single one of the technologies that defines the next 20 years of industrial demand consumes silver, and most of that silver consumption is non-recoverable. It is used and it is gone. Mine supply has been flat for over a decade. There is almost no supply elasticity in silver because roughly 70% of silver is mined as a byproduct of copper, lead, and zinc. So even if the silver price triples, you cannot triple the silver supply. The miners do not respond to price. And on top of that, China controls approximately 60% of global silver refining capacity and has been quietly restricting exports of refined silver out of the country. We are now in the 5th consecutive year of a structural physical silver supply deficit. 5th year. And the industrial demand is not slowing down. It is accelerating. So when the monetary bid returns on top of the industrial demand that never stopped, you get the characteristic silver pattern that I have watched 3 times in my career. Silver lags gold for an extended period, lags it badly, frustrates every silver holder on the planet, and then silver overtakes gold violently, not gradually, violently. That is the pattern. That is what silver does every single time. So why is your gold position red while bombs are falling? Now you know. And more importantly, you now know what comes next because the recovery from this kind of suppression follows a pattern that I have studied across 4 major cycles, and it unfolds in 4 distinct phases. The first phase is the panic. It typically lasts 1 to 4 weeks. Sharp selling, forced liquidation, margin calls, headlines screaming that the gold trade is dead. Then comes the second phase, the absorption phase, which typically runs from month 2 to month 3. This is where retail capitulates and sells the bottom. This is where mainstream financial media declares that gold is broken, that the inflation hedge does not work, that silver was a bubble. And this is precisely when the strong hands begin accumulating. Then comes the third phase, the structural bid, which runs from roughly month 4 to month 18. Central banks accumulate, sovereign wealth funds accumulate, multi-strategy hedge funds accumulate quietly, methodically, off the headlines. And then comes the fourth phase, new all-time highs, which typically begins around month 12 and runs for years. Where are we right now? We are in late phase 2, transitioning into phase 3. We are at the exact moment when retail is selling and institutions are taking the other side of that trade. I am telling you that is where we are. Now I want to give you the 2 indicators that will tell you when this suppression is exhausting itself. Write these down. The first is the dollar index. When the DXY breaks below 97 holds, the dollar headwind on gold is finished. The second is the 10-year Treasury yield. When the 10-year falls below 3.5% and stays there, the opportunity cost headwind is finished. Those are your two signals, not the war headlines, not the oil headlines, not the financial media, not the analyst price targets. Watch the dollar, watch the yield. Everything else is noise designed to shake you out of position you should be sizing up. Let me tell you a story, 1979. Two brothers, Nelson Bunker Hunt and William Herbert Hunt, decided to accumulate physical silver. They bought somewhere between 100 and 200 million ounces of physical metal. They simply removed supply from the market, and the price of silver went from approximately $6 an ounce to nearly $50 an ounce in 14 months. 8-fold increase from two private actors. Now, I want you to imagine something. I want you to imagine not two Texas brothers, but a wave of global pension funds collectively managing over $50 trillion in assets. It's not our deciding that even a 2% strategic allocation to precious metals is the prudent response to what they are seeing in sovereign debt markets. Run the math. 2% of $50 trillion is $1 trillion. The entire above ground investable silver market is a tiny fraction of that. The entire annual gold mining output is a tiny fraction of that. Supply is fixed. Mining takes 7 to 10 years to expand. The price does not gradually adjust to that kind of demand. The price gaps. And that brings me to the morning I told you I would describe. I have watched this 3 times in my career. There is a specific kind of morning and a specific kind of market where you walk into the office. You sit down at your terminal, and the asset is no longer the price it closed at the night before. It is gapped. And you wait for the pullback. You wait for the dip to buy. You wait for the retracement that always comes. And it does not come. The next day it does not come. The next week it does not come. The price moved and it never came back. There is no entry. There is no second chance. There is no dip to buy. The chart has a permanent hole in it where the old price used to live. That is what a structural rating looks like. That is what I am telling you gold and silver are approaching. And the people who are waiting for the perfect entry, waiting for the bottom, waiting for confirmation from the financial media will spend the rest of their careers explaining why they missed it. Do you see it now? Because behind all of this, behind the mechanics and the central bank buying and the debt math sits a much older fear. The fear of paper. The United States dollar has lost over 90% of its purchasing power since the Federal Reserve was created in 1913. Germany in the 1920s. Wheelbarrows of marks to buy a loaf of bread. Zimbabwe in the 2000s, $100 trillion notes. Venezuela in the last decade. Argentina right now. Every fiat currency in human history has eventually died. Every single one. Paper is a promise, and promises can be broken by the people who write them. I do not want to dwell here because fear is not a strategy. But you cannot understand why central banks are buying physical gold without understanding that they, more than anyone, know how the story of paper money ends. So let me tell you what I see when I look at the audience watching this video tonight. There are 2 types of investors watching me right now. The first type sees gold down 13% from the high and silver down more than 40% and concludes that the trade is over. They read the headlines. It's not our job. They watch the price action, they feel the pain in their account, and they sell. And 6 months from now, they will be the ones telling their friends, I knew I should have held. The second type sees mechanical suppression. They see late phase 2 absorption. They see central banks accumulating at a record pace for 18 straight months. They see $39 trillion in debt that cannot be paid down at current rates. They see a 5th year of physical silver deficit, and they accumulate quietly while the noise is at its loudest. I have watched both types of investors for 40 years. I have watched the first type at every major bottom of my career. I have watched the second type at every major top. And I am telling you with complete clarity which one builds generational wealth and which one does not. Now think back to the beginning of this video. I told you about a meeting I called in 2007. I closed the door. I told the people in that room to prepare for something the textbook said could not happen. Nobody outside that room listened. 18 months later, the entire system nearly stopped functioning. Tonight, I called that meeting again. And this time, I opened the door. You walked in. You sat down. You listened. I showed you the mechanism. I showed you 5 decades of historical proof. I showed you the 3 structural forces. I showed you the 4 phases. I gave you the 2 indicators. I told you the Hunt brothers story. I described the morning the price never comes back. What you do with what I showed you tonight is your decision. It always was. It always is. But you can no longer say you did not see it. You cannot unsee this. If this is the kind of clarity you come to WealthWIRED for, the kind that reaches you before the headlines do, the kind that explains the mechanism while everyone else is still reacting to the price, then make sure you are here when phase 3 confirms. Because once the moves from quiet accumulation into the breakout, the conversation changes entirely, and I want you in the room when it does.